Thanks for clicking. Inflation is beat, interest rates are coming down, and we're going to be seeing a soft landing. This was the message taken by the markets following a speech by U.S. Fed Chair Jerome Powell last week.
Yeah, I think we're done here.
Indeed, following the perceived victory over inflation, the bond markets took off, with yields on U.S. Treasuries falling, and those on 5-year government bonds following suit, hitting lows not seen since May of this year. Yet, despite the media's apparent sole obsession over the timing and extent of rate cuts, especially those coming from the Bank of Canada, others are pointing to some potentially more significant moves coming out of the U.S. in 2024, including the shrinking of the Fed's balance sheet, problematic to say the least U.S. debt problems, and a potential recession, all of which could have a bigger impact on Canada's economy than a simple rate decision here or there.
Really?
Given that, as we've seen all year, developments coming out of the United States have an even greater impact on the Canadian economy than our own developments, I think it's worth going over some of these lesser discussed issues and trying to understand the dynamics that we'll be facing in 2024. So what I want to do today is go over the Fed announcement that sent markets soaring, discuss what the Fed is doing with its balance sheet amid U.S. debt problems, and how it relates to what Peter Schiff had to say during our interview last week, and then discuss how these issues could affect the Canadian economy throughout 2024. This is my last video of the year, as I am going to be going on holidays until January 8th, but I want to wish everyone a Merry Christmas, Happy Holidays, etc., and thank everyone that's watched throughout the year, and for the great discussions that we've had throughout the year as well. We will continue to track what happens with the Fed, the Canadian economy, the Bank of Canada, and the real estate market throughout 2024. Click like and subscribe if you want to get those updates, but for now, let's get into this Fed decision. Onto the Fed's decision. Unless you've been living under a rock for the past week and a half, you know that the Federal Reserve announced last week that it planned on cutting rates by 75 basis points, with the markets and others taking that to mean that 150 basis points in rate cuts were coming in 2024.
And when that day comes,
the media and others took that to mean that the Bank of Canada would also be delivering those much-anticipated rate cuts in 2024, noting that the cuts could save the mortgage market. Yet, few considered the other, potentially more important message coming out of the Fed chair, that while the Fed may indeed loosen on rates, they are, right now, continuing on quantitative tightening.
The is that?
Very briefly, as we've gone over this at great length on this channel, recall the quantitative easing that the Fed did during the pandemic, where it bought up U.S. Treasury bonds and mortgage-backed securities from the banks, injecting trillions of dollars worth of cash into the U.S. banking system. And it wasn't just the Fed, the Bank of Canada did it too, buying up hundreds of billions of dollars worth of bonds from our banks. So, the central banks during COVID bought up trillions of dollars worth of government bonds and mortgage-backed securities from the banks with printed money. The Fed, the Bank of Canada, hold those bonds on their books. They're just keeping those bonds for now, and the banks can do whatever they want with the money.
You will thank me later.
Fast forward to now, and the Fed is doing almost the opposite. Quantitative tightening, trying to pull that money out of the economy, reduce the amount of money floating around, which it hopes will reduce inflation. So, the central banks injected money, printed money into the banking system, quantitative easing, which created inflation. Now they're doing quantitative tightening, trying to get that money out of the system. Incredible, isn't it, that the central bank and others seem readily able to understand how to cure inflation, get the money supply out of the system, reduce the money supply, yet very few proclaimed to know until it was too late that increasing the money supply would cause inflation to begin with.
I forgot to tell you.
Regardless, the Fed isn't doing exactly the opposite of QE. They're not selling their bonds. They're letting those bonds run off their balance sheet. They're letting those bonds get paid out. So, say a U.S. government bond comes due, the government owes the holder of that bond, in this case the Fed, all of the money that is due on that bond, including all of the interest that was accrued. The Fed, when doing QT, just allows itself to get repaid. The government pays back the Fed the money it owes on that bond, and the Fed doesn't buy another bond with that money. In essence, the money paid to the Fed ceases to exist. It disappears. But the problem lies in that the government has to get that money from somewhere in order to pay back the Fed. The government, which was once borrowing money from the Fed, borrowing from the money printer, using the banks as an intermediary, now has to find another lender in order to pay back the Federal Reserve.
Don't you mean Ponzi scheme?
And that's where we get to the heart of the problem. The amount of money in the system is drying up. When the Federal Reserve printed those $4 or so trillion to buy up those bonds, the banks had to do something with the money. And a lot of it ended up in what's called a reverse repo facility, an account at the Federal Reserve where the banks and money markets can put their money and receive interest from the money printer.
Seems fair.
But as yields on short-term government debt have reached over 5%, a lot of that money has been leaving the reverse repo facility. A lot of that money has been used to buy up U.S. government debt. And with quantitative tightening and growing U.S. debt issuance, that money sitting in the reverse repo facility, which is still draining, will have dried up by around May or June, according to Barclays. At that point, once that facility has been drained, there will be one less buyer, one less source of funds to buy up U.S. debt. Now, U.S. banks still have about $3.5 trillion sitting in reserve at the Fed, but even Chair Powell noted at his press conference that these reserves would start to fall once the reverse repo facility is completely drained. So, just to summarize, during 2020 and 2021, the Federal Reserve printed a whole bunch of money, which had been sitting in the accounts at the Fed, have been sitting on reserve and in the reverse repo facility. But those funds are continuing to dry up as they fund U.S. fiscal borrowing needs.
Give me the money.
I'm sorry.
And there is a lot of borrowing needs next year, with the U.S. expected to have to renew $7.6 trillion of existing debt and estimates of $1.8 trillion in new borrowing in 2024. So the U.S. is going to be going to the market for about $10 or so trillion in new money at a time when its debt is already at its highest level since World War II. And as we've seen, demand for that debt could be drying up. And it's not just domestic demand that could be drying up either, with growing calls in China calling for an orderly reduction in the holdings of that debt. So all of that printed cash from 2020 and 2021 is drying up. International holders of U.S. debt are becoming less willing to buy up that debt. Who's left? The Federal Reserve, with estimates pouring in as to when the Federal Reserve will have to step in, ending QT, basically starting to buy new bonds when old bonds are paid off. The Federal Reserve buying up U.S. bonds. And this is what Peter Schiff was talking about last week during our interview. With few players being able or willing to buy up U.S. debt, the Federal Reserve might have to act as the lender of last resort for the U.S. government.
And I don't think it's going to be easy to find new lenders that want to buy that paper at a rate that is affordable to the U.S. government. So, they're going to go back to QE. That's going to be more significant than what they do with rates.
But, so what? The Federal Reserve has to halt QT. It starts buying up bonds again, maybe even starting QE. So what? What's the effect on Canada? What happens to the Canadian economy if the U.S. starts printing money again?
I'm buying a boat.
Well, maybe. The last time this happened was back in September of 2019, again, as a result of the Federal Reserve trying to run down its balance sheet, trying to engage in quantitative tightening. Back in September of 2019, overnight money market rates spiked as there wasn't enough liquidity, there wasn't enough cash in the banking system, due in large part to corporate tax states and net Treasury issuance. Sound familiar? The Fed had to restart quantitative easing back then, buying up what was planned to be $400 billion worth of bonds per year. And while the Fed was insistent back then that it wasn't doing QE, others disagreed, with former Fed official Danielle DiMartino Booth noting that the Fed interventions are having a huge effect on the stock market, at that point hitting record highs, and Morgan Stanley told clients that the Fed was loosening market conditions in order to boost growth. We don't really know what the effects of that not QE would have been, as of course it only went on for about 4 or 5 months and about $500 billion, and then of course COVID hit and the Fed added another $3 or $4 trillion for good measure, of which we know the effects. But safe to say, of that $400 or $500 billion that the Fed injected in 2019, early 2020, was definitely stimulative. But for our purposes, here's the key part. Back in September of 2019, when the Fed turned on its money printer, Canada didn't turn on its printer. In fact, at that time, the Bank of Canada held rates at 1.75% and kept them there until COVID, with Bank of Canada Governor Stephen Pallaz expressing a worry that lower interest rates could spur a new round of bidding wars in the real estate market.
I just can't explain it.
In fact, even while the Fed's money printer was going buzz, Canada maintained the highest policy rate of all advanced economies, even after the Federal Reserve cut rates. And remember that when you hear that the Bank of Canada has to cut rates because the Fed did, that's not necessarily true.
Since when does that matter?
We had rate cuts and basically QE coming out of the Fed in late 2019, and the Bank of Canada held rates steady, keeping the highest rate of all advanced economies. With that said, our policy rate back then was actually in a stimulative position, sitting at 1.75 when the inflation rate was sitting at 2, compared to now when the policy rate is largely restrictive, sitting at 5% when the inflation rate is sitting at 3.1. If we get into 2024 and Canada's inflation data is still proving sticky, if we're still not back to that 2% target, at a time when the Federal Reserve is basically forced to turn back on the money printer, will the Bank of Canada follow as well? It didn't back in 2019 out of a fear of inducing more bidding wars, back when the benchmark price of a home was $534,000, $200,000 less than the $735K that it is right now.
Unless...
If the Federal Reserve is forced to return on the money printer, does the Bank of Canada follow suit and risk reinflating the housing market, risk re-accelerating inflation? Then again, if the bank doesn't follow the Fed, eventually that is, it doesn't need to right away. In fact, Canada's policy rate is often higher than that of the US, but if it doesn't follow the Fed, eventually, then that will increase the value of our currency, which will put downward pressure on our exports, which can hurt the economy, which technically isn't the Bank of Canada's job, but that's a dynamic I'm sure we'll get into next year. So, with growing US debt problems set to hit $1.8 trillion in their deficit next year, having to borrow about $10 trillion from the market with minimal demand at current rates, the Federal Reserve may indeed have to step in. And the Bank of Canada very well could find itself in a bit of a bind. Does it loosen to follow that of the Fed and risk reinflating our market? Or does it keep policy tight? Does it keep interest rates high and prop up our currency? Not prop up, push up our currency, which will hurt the economy. This could very well be one of the main dynamics that we see going into the latter half of next year. Maybe even earlier. Now, this might seem like a new problem, but it's not. It's the continuation of an old problem, a problem that we had back in 2019, before that really, but let's say 2019, when the Federal Reserve had to step in 4 years ago, step into the market, when there wasn't enough buyers of US debt. The problem was still there over the past 3 or 4 years, but it was hidden, it was masked by the Federal Reserve injecting $3 or $4 or so trillion into the US banking system, papering over the problem as it were. But now, the problem's worse than it was in 2019. As we saw, the US needs a lot more money than it did 4 years ago. We just underwent the biggest bout with inflation that we've seen in 40 years, and investors, lenders, might be less than willing to lose purchasing power, even more purchasing power, by lending the US government money, hence necessitating the Federal Reserve stepping in. This could play out in any number of ways next year, and I'm not going to pretend that I know what the end game is.
Well.
With that said, I think US debt problems, US structural debt problems, combined with a lack of liquidity, combined with a lack of demand for that debt, and a Fed that's shown a willingness to print when things get tough, I think this is going to be an important dynamic to the Canadian economy throughout 2024. One that isn't being talked about, but one that greatly matters. With that said, we are definitely going to cover that dynamic on this channel throughout 2024. Make sure you click like and subscribe. I hope everyone has a Merry Christmas, Happy Holidays, all that good stuff, and thanks so much for watching.